Well, for more on the fallout from OPEC and Russia, as well as the outlook for oil production, we're joined by Kent Moores, Executive Chairman at Energy Capital Research Group from Fort Lauderdale. Thank you for joining us again.
Thank you.
So with Russia not on board, at least for now, with these OPEC oil production cuts, what position does this put the industry in?
Well, the industry has already been in a difficult position. This simply makes it worse unless there is a resolution of the disagreements that arose in Vienna. We will be retesting the market lows that we experienced in 2015. In other words, low $30 per barrel, and the market in general and the sector specifically cannot withstand that for any length of time. We will see massive waves of mergers and acquisitions in the United States, but we're also going to see a ripple effect through the economy that's going to have a parallel impact to the COVID-19 or coronavirus problems we already have.
Now, we may not be getting a decision anytime soon. I mean, Russia's energy minister told CNN that the country would make its own decision on April 1st when the current supply restrictions are being revised. What are the consequences for the global economy if they decide not to go along with the proposed cuts?
Well, in point of fact, we don't know. What Novak actually said was that by April 1st, all of the participating nations can make their own decisions, which means every member of OPEC, Russia, and any producer outside of OPEC who was involved in the OPEC plus agreements previously. Of course, the United States and the shale producers in this country have no say whatsoever, nor do they participate in the OPEC or OPEC plus meetings. So they're by and large a sidebar participant here, but the protracted decline in oil prices are going to begin creating serious difficulties in the American oil patch.
So then what does the fallout look like then for some of these non-OPEC plus countries?
Most of the nations in both OPEC and certainly the non-OPEC, OPEC plus nations are dependent upon the production and export of oil to maintain some semblance of balance in their central budgets. Each one of these nations are in deficit, and those deficits are going to be expanding as we move forward after April 1st. One of the problems that energy has, and oil has specifically, once you get into unknown territory, is that traders tend to use future contracts to overemphasize the trend they see developing in the market. And the trend after April 1st is clearly going to be going down, which means the traders will accentuate that and will have another overreaction of prices well below where the market would support them.
And you mentioned that COVID-19 is adding pressure to the industry. So talk us through what was already happening with oil demand even before the COVID-19 outbreak.
That's correct. The best estimates that are, and of course we're dealing here with preliminary estimates, but the best estimates that I've seen indicate that over the last quarter we actually had a decline of 2.7 million barrels of oil demand worldwide per day because of the COVID-19 virus. Now, I regard such figures as being very problematic. To have figures that are of any consequence, you need at least 3 or 6 month lead time, but the current market isn't going to wait for that. This market is going to trade on emotion.
So then are production cuts the best way to go, or are there other possible solutions that are really facing the industry right now?
Short term, there really isn't. Short term, the problem is that supply exceeds demand. Now, ultimately, if things stabilize and economic development starts improving, then we can see demand kick in. In point of fact, we're likely to see a marginal increase in demand once we get to the end of 2020, but that's going to be dwarfed by the rise of supply. And the problem we have after April 1st is that every nation who produces of any consequence is now going to have the right, and in some cases the obligation, to simply open the taps, and we run the risk of being flooded with an amount of supply that simply can't be absorbed by the market.
So then what does this mean in terms of keeping OPEC and OPEC plus nations together? Could that relationship potentially be in jeopardy?
I think the longer this continues, OPEC plus may be in significant jeopardy. And we've already seen in the past that that members of OPEC itself have not always been on the same page when it came to policy. Now here, everybody in OPEC recognizes that if push comes to shove, the Saudis will use their tremendous volume to continue balancing production inside OPEC. So if other nations don't cut, the Saudis are likely to cut as a consequence. However, there's now a caveat these days that didn't exist last year or the year before. The Saudis must maintain a high price of oil in order so that the Saudi Aramco IPO doesn't fall through the floor. They now have a vested interest in maintaining the overall value of Aramco stocks in international markets, and that's essentially done by the overall valuation of the oil reserves in the ground that Aramco has in Saudi Arabia. So they are somewhat limited on going along with increased production without shooting themselves in the foot.
A tough balancing act indeed. Thank you so much, Kent Moores there, Executive Chairman of Energy Capital Research Group, for joining us from Fort Lauderdale.